Investing for positive impact. What is needed to scale up? My name is Miranda Johnson. I am the Southeast Asia correspondent for The Economist, and I'm delighted to welcome you all to this panel this morning. It's both going to be an interesting discussion and an extremely important one. To get things started, I'm extremely honored to be able to invite up President Jim Kim of the World Bank Group to deliver opening remarks.
Thanks, everybody. It's great to be here, and I'm so glad that we have a full house, because I have to tell you, I think there's truly nothing more important than for this particular community, the private sector, the public sector, multilateral development institutions, to get this right. I want to start off, so I don't forget, thanking the groups who we've been working with, the CDC, this is the British CDC, Credit Suisse, EBRD, the Inter-American Development Bank, and OPIC. We're doing this together with these other institutions. And I also want to thank very much the folks in the room who already have been working on this. We are absolutely not reinventing the wheel here. What we want to do is use the convening power of the multilateral development system to be able to give real teeth and perhaps broader acceptance to the things that you've already been working on. We know that. I specifically want to thank Philippe and Hans-Peter from IFC. I've been pressuring them to jump into this and do it for some time, but they did it faster than I ever expected, and I hope you'll all agree that with tremendous results. I apologize for the people who prepared my speech, because it's a wonderful speech. But I talk about this so much, I just want to tell you how I see this, right? And I talked about it today. We have multiple overlapping crises. You know, the climate change report that came out of the UN, it really brought together many of the bits and pieces of information that we've been hearing for a very long time. We are really running out of time. And you know, it doesn't seem to shock people that every year we have 2 or 3 1-in-1,000-year storms. There's got to be some calculation going on. What does that actually mean? Most climate scientists will tell you it's pretty simple. If the air is warmer, it holds more water, and if it holds more water, the events are going, the climate-related events are going to be more severe. Now, I come to the conclusion that no matter what you believe, about climate change, the question is, are there ways that we can help people make more money? Are there ways that we can help people feel like they understand risk better, and that even if they don't care, we can show them that they're having a great impact, not only on their own bottom line, but in developing countries and for the world. This has to work. If we do not find a way to accelerate impact investing around climate-related issues, we're all going to be in very big trouble. And if you look at the time scale, we have about 10 years. There are no forces that exist in the world that are anywhere near as powerful as market forces in getting us to a point where we are really building a completely different energy foundation for the economy of the future. That's one problem. The other problem is that aspirations around the world are going up dramatically. I mean, the market forces are aligned to provide everyone in the world broadband access by about 2025, 2030. And we all know what happens. People access to broadband, they access to a smartphone, they see how everyone else lives, and aspirations go up. And there's just no way that we're going to be able to reach those aspirations unless we can mobilize all the private sector money. If we just mobilized all the private sector money under the control of people who already talk about impact investing, which is quite a bit, we could transform the world. You know, the numbers, again, just don't add up. Anywhere from, you see a lot of different estimates, but anywhere from $2 to maybe $7 trillion a year to meet the Sustainable Development Goals. And official development assistance is 140 to 150 billion a year. And there are still people out there who say things like, you know, for a soda pop and a popcorn, we could give more money and then we could solve all the world's problems. Look, If you know of donor countries that are having intense discussions about how they can increase taxes and give away more for ODA, tell me who they are. I haven't met them yet, right? And so in a very practical way, that's not going to happen. And so where can we go? Well, 6 trillion still, with interest rates going up, with concerns about interest rates affecting the stock market, $6 trillion still in negative interest rate bonds, about 10 trillion in very low yielding government securities, and 9 trillion still sitting in cash. I want to meet the people who are holding 9 trillion in cash. It's such an interesting proposition to me. And then you have people like Larry Fink, who really is trying to figure this out. And so they have 6 trillion under management. And Larry says it in a pretty straightforward way. I really am committed to having greater impact. And as long as you can get 8% gross, 6% net, we will look at anything, right? But here's my most fundamental view. Most people still certainly in the asset allocator world, maybe there are an increasing number among asset owners, especially millennials who are inheriting money from baby boomers, who are saying, you know, we are the asset owners and we really want to have an impact with our capital. But for most of the asset allocators, it's still really pretty straightforward risk reward. You know, the people who are on this panel have now added risk reward impact. But if you asked how much of the assets in the world are really being invested with that kind of thing in mind, I don't think it's very much. So one of the things we have to do is to say, okay, then it will be really important for us to change the way the world thinks about risk. So we've had a bunch of meetings with BlackRock, and I have to tell you, I think Larry Fink is very serious about it. I think his teams are very serious about it. So we agreed that we're going to take all of our data and we're going to try to help them populate their famous Aladdin system with much more of the data that we have, so that the specificity of not just countries, but sectors in countries and firms within sectors in countries can be included in the Aladdin system. Now, you know, it's not just BlackRock that uses Aladdin. Other Vanguard, other major firms use Aladdin. So we think that if we can impact the way risk is thought of and the way risk is measured, we can have an impact there. And then finally, of course, it's also how you measure impact. And again, there's been a lot of great work, and our aim is to do what we did with the Equator Principles, is use the experience of IFC. I mean, there's some $228 billion in quote-unquote impact investing, but the vast majority of that is in the developed world. Still, 75% of all the impact investing in developing countries are the multilateral development banks. IFC has been doing it forever. So with that experience and with that credibility, with the convening power, our goal is to bring everyone together to, by the spring meetings, come up with a much clearer sense of what the principles of impact investing might look like, so that when we say risk, when we start out by saying risk, the understanding of risk will be much more nuanced, with much more specific data about developing countries. Reward will still pretty much stay where it is, but you know, given that one asset allocator or one group, BlackRock, has $6 trillion under management, and that the leader and the board and everyone is saying, we want to have a greater impact. You know, I think that we can expand the pool of who we appeal to do impact investing. And then finally, of course, actually define impact, and also have a system where any group's investments then will be independently verified, because we really want to avoid the problem that we had with green bonds, with greenwashing. So, I'll tell you, I think that one of the things that we need help from the private sector is that very often we, the multilateral development banks, are the problem. And the shift within the World Bank Group came when Philippe came to a meeting of all the vice presidents. And he, in his typically straightforward way, he said, you guys talk about billions to trillions, but what I'm seeing out there is billions to millions. And he said, you guys in the public sector, every time there is a a project that looks commercially viable, you rush to provide a sovereign guaranteed loan because it's easy. It's easier for the country, it's easier for you guys, and what we see is not only you crowding out IFC, but you're definitely crowding out the private sector, right? Now, IFC knows that there are private sector companies that say that IFC crowds them out, right? But the point is, Philippe got us thinking in a way that is so different from what we thought before. And what we have been saying, and I have to tell you, I think this is the reason we got our historic capital increase in April, is we said that we are going to move toward being the facilitators of the movement of capital rather than running around jacking up every country's debt to GDP ratio. Now, look, I'm being pejorative, but there is a problem with sovereign debt. There are many more low-income countries who are now running into debt problems than before. And I have to tell you, part of the issue is that we have been competing with each other for the low-hanging fruit. And the low-hanging fruit, by definition, should be financed on commercial terms. We can do that. So all I can tell you is that we are committed to making that change in the World Bank Group. There are many more examples in the World Bank Group where public and private are working together. I mean, the ideal scenario would be that we identify 5 projects. One is commercially viable, even IFC doesn't touch it, right? And it goes forward. Another could be commercially viable, but there needs to be some policy changes in the government. So the World Bank provides a direct budget support loan, and that budget support loan is directed toward making the policy changes necessary to make that second project commercially viable. The next one is a project that could be commercially viable, but will take a lot. Some partial risk guarantees, maybe political risk insurance, credit enhancement, creating a debt instrument where IFC takes first loss. Whatever the things that are needed, we use all of our tools to make that also commercially viable. And then eventually you get to things that have to be financed through grants or loans and from the government. But this should end up being almost like a code of practice. There should be like a Hippocratic oath type thing for multilateral development banks, and people should have to swear, I will not provide a sovereign guaranteed loan for a project that's commercially viable. Unfortunately, that doesn't happen. And the only thing I would ask of you is it will only happen if you and the governors and everyone in the world demands that it happens. Right? If you demand that it happens, we'll have to move more quickly, and all of the multilateral development banks will have to move in that direction. Look, if we don't do it now, we'll have to do it eventually, because once the real impact of climate change is seen, once we see what it means to leave huge proportions of young people unable to compete in the economy of the future, at that point we'll be scrambling. What I'm suggesting is that this particular effort, impact investing, is the greatest hope we have to not wait, to not have to experience those awful outcomes before doing the right thing. And in this case, it's doing the right thing for the private sector, but most importantly, it's doing the right thing for the poor people of the world. Thank you.
Enormous amounts to be discussed there, and I'm delighted to say that I've got a full panel to help me with that. Please come on stage as I mention your name so we can get things started, get things flowing. Initially, I'd like to welcome Axel Weber, who is the chairman of the board of directors at UBS, Andy Cooper, the founder and CEO of Leapfrog Investments, Charles DeLara, who is a partner and a member of the board of directors and chairman of the Americas at Partners Group. Also, Marianne Hancock, who's the CEO of Rise Labs, Valdis Dombrovskis, the Vice President of the European Commission responsible for the Euro and social dialogue, and he also, on top of that, is in charge of financial stability, financial services, and the Capital Markets Union. Of course, last but not least, I'd like to welcome on stage Philippe Le Houerou, who is the CEO of IFC and an extremely important person in all of this. He, unfortunately, will not be able to stay with us for the entirety of the panel. So if you see him disappear at any point. Please don't panic. He is, in fact, going to be replaced halfway through or so by Hans-Peter Lankes, who's the Vice President of Economics and Private Sector Development at IFC. A fantastic panel. Please welcome them. Well, thank you all very much for being here. And obviously today it's exciting because IFC is releasing its draft of operating principles for impact management to try and sort some of the issues that have plagued impact investing around fuzziness and uncertainty of definitions. I mean, Philippe, I wondered if you could kickstart things by explaining, why IFC decided to undertake this mammoth task and produce the principles.
Well, thank you, and welcome everybody for this to this panel. I think indeed, as Jim said, we believe it is potentially very powerful. Now, why did we start that? When I started 2.5 years ago in IFC, it was the 6th year's anniversary of IFC, which is great because I love history, so I had to go back to history of the IFC. And one thing that came very clearly is that one of the things that IFC has done because of the public and multilateral dimension of IFC, we set standards. You heard Jim talking about the Equator Principles that came in 2003. And it is basically the key principles on environment, social, and governance for project finance. So a lot of the banks in the world have adopted this principle, and we update them regularly. In fact, this month in Washington, we'll have an update of these Equator Principles. Then I saw that on the green bond market didn't exist 10 years ago. Nothing, zero. It started with MDBs. The first green bond was done by EIB, second by World Bank, EBRD, IFC, and then we came together and decided what are the principles, because you don't want greenwashing. It's all very nice, so you have people that think that they're going to buy something that will do something for the environment, and then if you have greenwashing, that can be a total collapse of the possible asset class. Now, it has been a great success thanks to these principles. We went from 0 in 10 years to 150 billion. And I saw some projection for this year, calendar year, to go to 300. So, I mean, this is a huge asset class, but we needed these principles. So, when we started, clearly the board was challenging us. And also what I look for the history is that the IFC was created in 1956, so 60 years, 62 years now. And we were de facto the mother of all impact investors back in the days, in 56. No banks at the time, let alone no other portfolio manager, who were investing in developing countries. Third world, it was called, by the way. Then IFC created the expression emerging markets in the 80s. Why? Because it was very hard to engage with Wall Street talking about third world investment. So they transform it in emerging market, is more exciting, and it started to work. So, and then we basically did our own homework to be able to quantify the development impact of every single project that we do. Like we have internal rate of return, we have an economic impact number for every project. There's a methodology behind it. So we thought we are pretty well position in our view to say, fine, we see that, as Jim said, that the millennials, there's more and more interest in this impact investing. We thought that it may be time to take it early in the game to define what are those principles before you give it a bad name if it goes without principles and without clarity. Because I saw in the FT, there's fundraising already based on impact. But impact on what? Measured how? Verified by whom? I mean, this is what we're trying to do. And last, I can go on forever, as you can see, but I want to thank the member of these panels because, as Jim said, we took the train that was already, that left the station and but we think that it's nice for a multilateral to put some principles around. But the true, on the private side, we have in this panel the true forefathers of this impact investing, and we want to work with them and bring some other in the tent. And we're talking about the numbers. 35 billion is what we have here a year, which is peanuts. But it's not very clear what it is. So what we committed to do is also to have for the spring meeting, which means 6 months from now, to have a piece of analytical work on impact investing that will scrub the number, validate what we're launching today. This is draft, we're talking about the draft today because we want this open discussion. And hopefully, as Jim said, by the spring meeting to have at least the first round of adoption and signing. Sorry, it took a bit of a long time, but I like history.
No. And I was wondering sort of, to further explore precisely, what the guidelines will mean and what they will change. I mean, perhaps starting at Marianne, if you'd be so kind as to explain their significance for Rise Labs, and then we'll continue down the line, if possible.
Sure, thank you, Miranda. History tells us so much because the reality is that every allocation of capital has an impact of some sort. And the problem is that we have not been very good historically at pricing the negative and the positive consequences of that impact. But history also can give us hope. If we think about pre-revolutionary France with over 250,000 units of measurement, and then they brought in the metric system. Or we think about the fact that concepts in finance that we take for granted did not exist a century ago, whether it's IRR or it's standards of accounting. And history is being made this week with the Human Capital Index and valuing a part of the wealth of nations that we have not valued appropriately. So we can do this. And these guiding principles bring us towards that by helping us think about the discipline process we need to have. The Rise Fund experience, for me, reminds me that we can do this. And so if I take just as an example, principle number 4, which is to assess the expected impact of every investment based on a systematic approach. So we underwrite the impact side in due diligence just as rigorously as we underwrite the financial side, which means that we have to turn to third-party research for every investment to understand, will it have impact, how much impact will it have, how much will that impact be worth in economic terms, to think about that in terms of what we call an impact multiple of money, to value that, to think about the hard things like if we care about longevity of impact, how should we translate that into terminal value? These are technical, but they're important. And so this work is hard. It's not easy work, but it leads us, and by the way, when we're putting as much capital to work as we are in this short period of time, we have to be efficient, we have to be practical. But it leads us to better and better assessments, and it also shows us we can do this.
Thank you. Valdis, can you give us the sort of the political significance of these principles?
Good morning. First of all, thank you for invitation to this discussion. So I will probably concentrate on what we are doing in European Commission in terms of sustainable finance. I know impact investing is a broader topic, so I'll try to enlarge. But what we have now practically started to put in place is an action plan on green and sustainable finance. Because if you look at climate change, recently there was also the report of intergovernmental panel, which was, I would say, quite alarming. Also the fact that 17 out of 18 years in recorded history, the hottest years, have happened since the year 2000, shows that this is a real worry and we need to act now. So we put forward European Union's action plan on sustainable finance in March, followed by several concrete legislative initiatives. Our assessment is that in order to meet European Union's part of the Paris Agreement of the climate change goals, we need additional 180 billion euros annual investment. And it's clear that it goes beyond the scope of only private sectors, that we need also, only public sectors, that we also need a private sector to fully play its part. And the role of capital markets, financial markets, can be a major role and probably relatively overlooked still at this stage. So what do we now concretely propose? We put forward three draft laws in May, first on taxonomy, so the classification system to define what is green and what is not, exactly to avoid greenwashing. We put forward a proposal on benchmarks, low carbon benchmarks, positive carbon impact benchmarks, and we put forward proposal on disclosures, how asset managers, institutional investors need to disclose on green and sustainable factors. Of course, it's only part of our action plan. Further actions will follow. Those are the first three proposals which are on table, but we think that we can then build on those proposals, and taxonomy is quite fundamental, because indeed, first you need to clearly define what is green, and then you can build on this, including, for example, on building EU green financial label based on our current eco label, which is for a broader set of goods. So we want also to create an EU green label for investing. The good news is that demand seems to be there. We sense that there is a demand, including from retail investors. If you look at some surveys, 3/4 of investors had said that they have those sustainability considerations as more important considerations now as it was 5 years ago. If you look at the younger generation, figures are even higher. So basically we need to match this demand with also clarity, more clarity in when investing in green and sustainable.
And I think that's the crucial point about the principles, is that they seem to be trying to address some of the same issues around clarity and definitional certainty. I mean, I wondered if I could just throw the ball to you, Andy, on this and on the principles, because it's fascinating to hear on the government side, and on your side, I wondered if you could also add to Marianne's kind of contextualization of why they're important.
Leapfrog was started in 2007, prior to the existence of the term impact investing, and when we began, this seemed to be a space that people thought as weird or strange or very fuzzy or soft and social and not relevant to the financial markets. And what we've seen over a decade of demonstration, even more than remonstration, is that impact and the pursuit of purpose can significantly help with, as Jim Kim said, the quantifying and the understanding of risk, as well as with generating returns, some returns that are at the 6 or 8% level, as Jim said, and some that are outsized returns. And if you think contextually about a decade ago, the notion was that somehow impact must be sub-commercial. And while there are catalytic roles that a whole number of players can play, what has become very clear is that there is a spectrum right from that through to highly commercial, so that actually profit can juice purpose and purpose can juice profit. You can actually get something where there is a synergy, not a trade-off, between profit and purpose. And why are the principles then really important? Because this magnetic idea of profit with purpose is something that people with strong marketing strategies and distribution capabilities like to grab onto and use as a marketing strategy to raise capital. Now, I have no problem with that if they're doing it. And you've got to say what is actually doing it properly. And so you need a minimum set of principles, some basic standards that people have to meet, so that when they fall below it, it's impact washing, and we all know it. And then You need a set of principles that then allow those who aren't doing impact washing, who are doing it properly, to point to those and say, our measurement system captures and lives those principles. Now, those principles are not the whole measurement system. I trained in philosophy. I can tell you not all human goods are comparable. You can't come up with the complete solution, and no, not everybody will agree on a total measurement system that covers everything. What we can agree is a set of principles that every measurement system has to meet in order to be credible. And today is an important day, because after a decade of leapfrog working on it, and many other players over a long period of time working on it, we're in a position to have draft principles that can go out to the global community and diverse sectors to consult with us on, and to get to a point where we can have a final set of principles at the spring meeting that, of course, will iterate, but fundamentally define the basic standards for the field. And this is a moment to celebrate, because it was inconceivable a decade ago, and in a decade's time, as Philippe said, we will have moved from billions to trillions, but we need to make sure that those trillions are resulting in genuine impact.
Of course. And on that point about purpose and profit, Philippe, while we still have you, I'd like to ask you, is there still a perception that there's a discount for virtue?
Well, not in IFC. I mean, on IFC, the way I think about IFC is, I'm French, but I lived in the United States, so I like baseball. I don't understand, but I like it. So, but I understand enough to understand the three bases. There's 4 bases, but I understand only 3. So for us, the first base is you do a project. I mean, we're a project finance institution, and then we move to equity, etc. But our DNA is project finance. Whatever we do, it's commercial. We don't get government guarantees, so we're really using all the instruments of the private sector. So when you make an investment, for me, the first base is you have to make money. If you don't make money, you have no impact, because the company is gone, or is not producing anymore, or bankrupt. So by definition, if you don't make money, you're not financially sustainable. All the nice investment thesis that you have is really for the birds. So sorry to be direct, but that's base number 1. Base number 2, you have to have impact, because we invest with a purpose, and that's, Andy says purpose, we say impact, and we've had development impact measurement for that. So we go to our board and we say, okay, this is what we plan to do. But then you have to measure it ex ante, during, and ex post, and validate. So that's the impact, but that's the second base. Then there is a third base for us that the others may not have. We are, and Jim Kim alluded to that. The third base is additionality. In other words, if the private sector can finance base 1 and base 2, we're out. So we have 3 things to demonstrate. First, it is financially viable, because if a company disappears, again, there's no impact whatsoever. Then the company will deliver beyond the profit the impact. If it is health, fine. What is it exactly in health? If it is, I don't know, education, if it is energy, if it is anything. And then the additionality. So we have an additional constraint than the market, because we don't want to crowd out the private sector. We work with the private sector, with private sector instruments. We have the jargon of the private sector. When in IFC, I always joke that when we talk about equity, it has a very different meaning in IFC than across the street in the World Bank, because equity means redistribution. For us, equity is kind of a stock in a company, a share. So I mean, so this for me is absolutely critical, that we have, in addition to the impact in IFC, the additionality. Again, so we have one more constraint than the market, but I think it's good discipline. Otherwise, there's no point to have a public, and that's why we believe we have the convening power, because we have this mission, that's Article 1 of Article of Agreement. And this is a part of the public good of IFC, to bring people under the tent, because we have this additionality. We are here to crowd in, not to crowd out the private sector and private finance. I'm not sure it answered the question, but that's what I wanted to say.
Fair enough. I mean, I did wonder, Axel, sort of from your side, whether you had, you know, a view on purpose and profit and their relationship, and also the perception of that relationship, and whether that's changing.
Well, so we at UBS are the largest global wealth manager with around 3.5 trillion assets under management. Most of our top clients are the richest and wealthiest clients around the globe. And when we work with them over generations already, the bank has a 150-year history, they want to solve generational problems. They're probably your most long-term oriented investors, and not listed companies. They don't have an accounting issue. All they want to do is invest this generation's money to the benefit of the next generation of the family. And so they're probably your best friends in terms of investment. And when we work with them, there's two strands where these families have been very dedicated. The first one is philanthropy, which has nothing whatsoever to do with it, with this part that we're talking about now. But if you're in philanthropy, you are used to measure success and impact as the sole thing you do, because you give money for achieving a purpose, but you forgo a return. And when we engage with these families, we basically been telling them that it's not necessary to forgo a return. You can do both. You can be profitable and you can have an impact. So the whole idea of bringing together impact and sustainable investing in specific causes and a return objective is, in my view, very, very core to making this an asset class. And the principles that are now being proposed here are exactly along the lines of what we have been pushing for many years. We issued in Davos a white paper at the start of this year where we already outlined, if you had such principles, this would be very, very good. Now, I'm very glad that under the leadership of the World Bank Group and the IFC, we're seeing these principles now being put together on paper. Let me say, I would go one step further. I'm also chairman of the IIF, which is the global banking lobby. At the IIF, I'm one of the trustees of the principles of sovereign debt restructuring. It is very important that when you have such principles, there is institutional ownership of that process, because there is a lot of greenwashing and there will be a lot of impact washing happening. It is very important you set standards. It's important you associate them with an institution. There's no better institution than the IFC or the World Bank Group to associate their name with those principles, and then everything that falls below that bar is actually impact washing and not impact investing. So it's very important to take that step and that institutional endorsement, in my view. It's great to have those principles, and we're very happy to contribute. And actually, I see a huge interest in our client base for exactly these types of investments where you do have an impact, where you do not forgo return, and where you actually are putting money at work that is doing something with a purpose and giving you a return. And that's an easy sell, as Andrew already said. If we bring that to our clients, there is a business case for it. And it's all about bringing private sector money, and even your private family money, to investing for the better. And I think that's a great part about these principles. And they will be a facilitator, in my view, quite revolutionizing financial investments around countries that have not been at the forefront of investor appetite. You're bringing investor appetite to these projects.
I'd like to pose a question to Charles, but before I do that, I'd just say that in a moment, if others out there have questions, I'll come to the floor momentarily. But Charles, I think I wanted to ask you something tricky, which was, from what we've heard, you know, it looks as though the principles currently in draft stage, but you know, they're moving forward. It's an exciting development. Impact investing has come a long way, as we've heard, since the 2000s. But the question posed by this panel, what is needed to scale up? Where do you think we go next?
Well, Miranda, if I may, allow me, before I answer that question, just to step back for a moment and say how encouraged I am, and how encouraged I think we all should be by the reality of this day. We're sitting here in October 2018, and the IFC is launching, on behalf of the World Bank Group, these draft principles for impact investing. You know, hardly a day goes by, certainly a week doesn't go by, when we all read articles or have conversations about the demise of the post-war world that was built for 7 decades, right? You talked about the celebration of the 60th birthday, Philippe, of the IFC. These are real concerns. Democracies are becoming hotbeds for populism. Strong men are appearing in many corners of the world. Multilateral institutions have outlived their usefulness, we've told. This is proof right here today that that is simply not true. To paraphrase Mark Twain, the death of the IFC is greatly exaggerated. No, it really is exciting because these are global. You know, the IFC and the World Bank focus on developing countries, they focus on emerging markets, they focus on frontier markets. That's what they should do. But here the IFC is not speaking just to a set of practices, a set of principles for investing in a select number of countries. There's no group one, there's no group two here today. This is about global investing. A firm like ours, Partners Group, will take these principles and will provide you feedback. We've already been working with your team to share our perspectives on this, and then we will do our best, Miranda, to put them to work. And that is key to the scaling up of this whole exercise. The magnitudes are potentially huge. The word that I heard from President Kim this morning and Philippe is catalytic. That's, you know, we are leveraging the credibility of the IFC here today. And the IFC is leveraging our balance sheets. It's a wonderful partnership. Firms like ours are already engaged in impact investing, and we're doing so in a very serious way. Just this week, I've spent hours on a wind farm that we are constructing and financing, a $2 billion project, $2 billion project in the North Sea that within a matter of a year will be generating wind power from some of the world's largest turbines for a whole swath of Germany, from Hamburg going down into the southeast, into the heart of Germany. This is going to significantly alleviate the CO2 burden in this part of the world. We're doing something similar in Australia today, where we are uniting 3 different solar platforms into one and creating the world's first solar to battery storage facility. These kind of projects are serious impact investing, but we need a framework. We're a private sector firm. We can bring a lot of capital to the table, but we need to do so within a framework of discipline, within a framework of transparency, within a framework of accountability. Our investors are pension funds or they're private families, as Axel was talking about. They expect us not just to wave the flag for impact investing, but actually deliver. If firms like ours put our shoulder to the wheel, we can scale this entire process up in an enormous way. But we also need to bring to the table, and that's where I would ask everyone in this room today to think about their responsibilities, the governments of the world, the sovereign wealth funds of the world, the pension funds of the world. Firms like ours depend on private wealth, insurance firms, pension funds, and sovereign wealth as our sources of funding for the projects we invest in. If our clients encourage us to move even more steadfastly in this direction, I guarantee you it'll happen. Now, we'll pull the process along even without their encouragement. But if every country represented here today ensured that its sovereign wealth fund was an ardent supporter of impact investing, you're going to get huge scaling up.
I just wanted to add to that, because this notion of we have to deliver for investors, along with the principles, those two notions are the critical things in scaling up. If you look at why it is so hard to produce a paradigm shift, it's first because there's no agreement on what the basics are. Today we start towards that. And second, because in the financial markets, demonstration is more important than remonstration. If you can demonstrate outsized returns, and you can demonstrate that you can do it at scale, then the game changes. When we started 10 years ago, people thought this was all very hopey-changey. And they said, where are the numbers? Now, when you can walk into a meeting and say, you know, here are 4 portfolios. These companies grow, leapfrog companies on average grow at 40% a year. This should be the envy of companies in other markets and investors in other markets. You know, these companies are acquired by folks like Swiss Re or Prudential or major institutions. And here is the financial opportunity to produce multiples of your money. Suddenly, the world's largest pension funds, insurers, family offices, sovereign wealth funds wake up and want exposure to this. But they also want to know that they're not going to wake up with their name in the paper for something that apparently is impact, but actually turns out to be extractive or exploitative. So the two things that are needed are this much clearer basic set of standards, fundamentally, and secondly, outsized returns. And if you think of what is happening, as Jim said, risk is mispriced. People are looking at emerging markets, growth markets. They're looking at a pharmacy chain in Africa and saying, oh, that looks small and unappealing, but actually it can be the Boots of Africa. They look at a small distributor of loans in India. Meanwhile, it could be the future HSBC. You know, the Prudential started as the man from the Pru, knocking on door to door for a penny. And now we have Prudentials being created in 5 or 10 years. Given the scale of technology scaling. So we have an opportunity now, I think, both with the principles in place and with some of the returns that are being demonstrated, to scale this to the trillions. And what's going to do that is returns, and it's going to be the principles.
Philippe?
I apologize, I have to go to this DC lunch. I really apologize because this is super exciting. But I just want to illustrate the purpose with a return. We have now, as I said, we talk about the Equator Principle. The Equator Principle is based on environment and social standards that we adopted and that the whole community of investment bank use. But now we have the data. And the thing is not published yet, so I'll give you the preliminary results. We looked at companies that have adopted our environment and social standards. And these are difficult, by the way, because we ask people to jump pretty high, and it's more costly at entry because the investment costs increases. The good news is that we're discovering in emerging markets that companies that have followed these standards have done much better in pure returns, hardcore, hard cash, X, than the company that didn't. So now we can discuss about the causality, but it's pretty strong. And we saw that in the OECD countries. Now we're seeing it in emerging countries. So just this kind of purpose with a return. This is not an abstraction. It's true. And now we have the numbers who start to kind of pile up. And it's like a snowball effect. The more we can demonstrate, the faster the snowball is gonna happen. And again, I want, before leaving and giving the seat to Hans-Peter and his team that has done all the work, I want to thank this panel. I mean, this is a fantastic bunch of people. We need to work together. We need to you have been, again, we are just trying to bring all this together, all your work, and to put it to the next level and bring other in the tent. So I hope that there will be a photograph when we say in 10 years, these guys made it, launched it. So thank you very much, and let's go together into this adventure.
Thank you, Philippe. At this point, I'll take a couple of questions from the floor, if anyone would like to throw out their hand. This gentleman just here. Oh, thank you.
Hi, Vugar Sadiq of Capital Bank, Azerbaijan. My question to Andrew, just to continue your thoughts, what we didn't really, you didn't, the panel actually elaborate is the artificial intelligence. So I think today we have, we'd say that we have two superpowers in artificial intelligence. And what do you think of the AI as a tool to really making the sustainable, impact as an investment tool? It is Because I'm worrying that in 5-10 years, if the emerging markets or developing markets, they don't really invest because of lack of education, maybe because of lack of other technologies, we're gonna come back again at this panel in 5-10 years and start thinking, okay, what we're gonna do, what kind of changes to scale up, really, what do you think, and maybe the role of the IFIs in this? Thank you.
Sure, well, let me give you a very practical answer to that, which is when we see what is coming out of the emerging markets, we are quite encouraged, because if you take a bottom-up perspective, there are quite a number of companies that are mobilizing AI and data to do absolutely revolutionary things. So Leapfrog invests in financial services businesses and healthcare businesses, mostly in Africa and Asia. And if you look, I've just come from Mumbai overnight, where I was meeting with Neogrowth, one of our portfolio companies that provides loans to shopkeepers, small and micro shopkeepers across India. Now, this is millions and millions of people. And previously, at the end of the month, what would happen is the debt collector would come, so you could give a little bit of working capital, and then you'd see whether they had money at this point, because their cycle looks like this, or not. And you had 12 data points in a year. Now, Neogrowth, every time a customer pays with a mobile, every time a credit card gets tapped, they get data on those customers of the shopkeeper. And so they have thousands of data points, and they take out a little payment on the loan every day of the month, generally from a mobile wallet. Now, when you look at that ability then to underwrite small shopkeepers so that they can get more loans, larger loans if appropriate, so that you can understand them better and provide a better quality product, and you can use AI to do that. The potential for companies like this to grow, and it grew at 76% a year last year, this company, the potential for companies to do that is enormous, and we see it across healthcare, where the data sets are being generated by private companies, because often it doesn't exist so well in the market. We see it across insurance, where you can use continuous underwriting. So people who were a risk that you couldn't price, you can now price by starting working with them and seeing what their behavior is. We've seen it across all sorts of areas, and so I actually think there is great hope. And what I would encourage the development finance institutions and international financial institutions to do is really start at that customer side and see the companies that are serving them, and then support the backers of those companies. Because in the end, where profit meets purpose is at the customer. Every customer of these companies is part of the revenue line, and they're a low-income person getting an essential service. So with Leapfrog's companies now reach 140 million people. If you look at the data sets that you can get out of that and the AI applications for that, you can build competitive advantages that weren't even dreamed of 10 years ago when this whole thing started.
Axel, did you want to come in?
I just wanted to, Felipe, when he left, said something very important. I want to take his view of the 10-year journey, but I think what we have done today, and Charles was very good in outlining that this is a historical starting point, but it's only a starting point. I want to map out the journey that I think we should embark on in the next 10 years. It's all about upscaling. The things that happen once you have such a standard, and once you audit it, and you bring really measurable success into the story, you can basically move to index funds that basically invest in an index of sustainable investments. So it's all about mainstreaming what at the moment are niche investments to really become standard. Once you actually have an index that is audited, where you know exactly what's in that index, you will get index-oriented investors who don't look at the details, but basically take a broad set of investments into that. Once you're there, you need to facilitate in and out trading of these indices, so you will develop derivative markets, you will develop deeper markets, you will develop more complex financial products around impact investing. So the whole journey is about creating an asset class rather than doing a partnership. And it's that creating of an asset class that will lead to mainstreaming impact investment And with what we've done here on the principles, we set the starting point because we have a definition. Now it's about putting content there, putting projects there, putting money there, and mainstreaming it. And that's a very important journey for the MDBs and for the World Bank and the IFC to understand that they need to partner with markets and bring in markets into products rather than bring in markets into regions or into certain countries is going to be a very important set of operations that these institutions will have to do in the future. It's about mainstreaming investment for, say, what we do around climate change. That can be a big part of such an initiative, and we cannot bring all the trillions of money that are needed to meet the Millennium Development Goals. We cannot raise that money in the public sector. We really need to leverage private money in that, and that's why it's such a good initiative.
If I may just follow up on a point that Axel made, we've launched in Partners Group a fund just this year called PG Life. And every investment that goes into this fund will have to be consistent with at least one, if not more, of the Sustainable Development Goals of the UN and have to be fully consistent with the principles that are hopefully finalized in April of next year by the IFC for impact investing. There will need to be a lot of rigor here, and there will need to be a lot of partnering, I think, with the IFC and other multilateral institutions for funds like PG Life and the DPG Rise, which you've launched recently, to really get off the ground and elevate. Let me give you an example. There are markets where investors, the pension funds that invest in Partners Group, expect significant returns from us, and they expect significant returns with moderate risk. They've invested a lot in government debt and fixed income bonds, and it hasn't done much for them over the last few years with low interest rates. I think today we're in an environment where private equity firms such as ours are expected to be able to deliver significant returns. There are parts of the risk spectrum which we simply are going to have difficulty dealing with. If the IFC can work with us to identify those slivers of risk in different corners of the world that make it difficult for the market to function effectively, and the IFC steps in, and it doesn't take a lot of coverage, it doesn't take a lot of guarantee. It can be very catalytic to lifting the amounts of capital that go into, especially frontier markets in various emerging markets. There are markets, and I'm pleased to say even somewhat challenging markets, and India is a good case in point, that can be challenging for private equity investors, but we've invested significant amounts of fund in a housing mortgage company there, which is doing something very similar to what you're doing. It's not to businessmen and businesswomen, it's devoted to primarily to female entrepreneurs who need mortgages to buy small homes. And this is being done strictly on a commercial basis, local currency funded, and it's going to be successful. But there are other markets where such projects simply will not get off the ground without firms and innovative thinking by companies like the IFC.
I had a nuts and bolts question kind of related to growth and how we scale up impact investing. And perhaps, Marianne, you'd be the person to take this, but how do you take these fantastic broad guidelines and actually sort of synthesize those strategic aims with management tools on the ground, as it were? I mean, sort of how do you connect the lofty and the pragmatic?
Sure. With a lot of hard work, but it's very doable. So let me give you an example. One of the things that we've talked a lot about when we talk about scaling is the amount of dollars. And we need to really think as well about the effectiveness of those dollars. One of the really important things that we all know about the $2.5 trillion annual gap to the SDGs or higher. What if every dollar was more effective? The analog that I often think about is, we're all very likely familiar with the deworming medication and the studies that showed that deworming medication could increase attendance at school. The interesting thing in those studies is that other traditional educational interventions were also examined, and they did have an impact too. So providing books or providing scholarships also helped us to keep kids in school. But the deworming medication was dramatically more cost effective to achieve the same outcome. There's no normal business decision that we would make where we would suffice with with an intervention or a solution that was a fraction of what we could deliver with a knowable solution otherwise. So when we think about the practicality of this, one of the things that's really important is that we actually turn to evidentiary research about how to be most effective in our investments. So one of the processes when we look at these principles is to take each and every investment, to look at maize productivity in sub-Saharan Africa, to look at what is going to really work to increase the net income of a smallholder farmer who's working in a dairy to provide the milk from his her one or two cows. Look to evidentiary research. There is an enormous wealth of research that can be tapped. It's not perfect, it's never exactly on point, but it's actually quite a substantial improvement upon dreaming up an idea in San Francisco or London or another city and saying it's going to work in a rural place in sub-Saharan Africa. So when we think about mechanizing this, turn to evidentiary research and then turn to a process that aligns the impact underwriting with the financial underwriting. They have to go together from the start.
Well, 10 years ago, we realized a lot of what was happening was that people would have a company that they owned. The CEO and the management team would be incentivized on the key performance indicators that were financial. And then at the end of the quarter, an analyst would tick through the ESG boxes. So it would be a lagging indicator and it would be separate from what the leadership team focused on. And what was incredibly central was exactly that in terms of the measurement system, was bringing forward the social indicators and integrating them with the financial indicators. And of course, your risk in running a business is having too many things you're chasing. So one of the things we found is that the financial and the social indicators are often the same. If you look at insurance or loans, renewal ratios are an example. Do people come back and buy your product? If they don't, they're probably not getting much social value out of it, but also it's a real financial problem for you and it's a risk. So what we created was a measurement system called FIRM, Financial Impact, Innovation and Risk Management Reporting, where you combine the financial, the social, the impact piece, the innovation and risk management into one set of metrics that each company can then adopt. And you can incentivize the management team appropriately on achieving those indicators. Now, once you shift to that mindset, you say, well, we have a set of principles. Now we need to say, how do those principles manifest themselves in a measurement system that quantifies risk and return and impact? And now let's drive the companies and incentivize people on that basis. And then you get a level of transparency for investors, but you also get a level of performance, whether it's for development finance institutions, sovereign funds, pension funds, insurers, family offices, that is outsized because you're not adding indicators at the end of the day that are lagging indicators. You're adding something that improves returns and manages down risk. And I think the principles are really central here, because what we want to see is a lot of measurement systems, sure, but every one of those being having a credible set of 9 principles to draw on as they get developed and as they get iterated forward.
Oh, sorry, Hans-Peter. Please come in. Welcome.
Thank you, Miranda. But I want to do something different. I want to emphasize that this has been a collective effort with many participating, those here on the panel, those that you see in the brochure, in the sounding board, in particular our partners among the multilateral and the development finance institutions. And if you allow me, I would actually ask whether Nick, CDC, could come in and give us a bit of a perspective on your question, if that's okay.
You're hijacking my panel.
I'm sorry for doing that.
Welcome.
Thank you, Hans-Peter. First of all, let me just congratulate the IFC on this. This has been a much-needed initiative, and they have proceeded with real urgency and pace and in a very collaborative way, and it's fantastic to see. So I think we really should congratulate them on that. Now, I have been Chief Executive of CDC for a year. I've been in the impact investment movement for about 10 years. And I think it's fantastic to see how that movement has grown over that period of time. But I do have to say that, and I think Jim Kim touched on this a little bit, the movement has been better at building a brand than it has been at moving money. And it's great to see the Larry Finks of this world sort of writing their letters to their shareholders. But the truth is that that is happening largely because this is a movement, this is a bottom-up movement. This is what institutions are hearing from their clients. They want to better understand how their capital is being used and what impact is being created. And there's not I suspect not a boardroom of any mainstream institution, investment institution in the world today that isn't discussing this question. And that's a great thing, but it does lead to the risk that everybody looks at what they do every day and then tries to apply an impact lens to it and then markets it as impact investment. So that's why these principles are really, really so important. But I want to make a couple of points specifically on the principles. The first one is, what is really important about these principles is not the 6 or 7 principles or whatever we end up with. It's the fact that there's a requirement for independent verification. And that is what makes them different. Now, it's very easy if you're a DFI or if you're a UBS, if you're a Credit Suisse, we are big institutions with lots of money. The investment management industry is a very fragmented industry. The impact investment movement or industry is even more fragmented. It is really important as we think about the verification aspect of this, that we think about what we're going to do, how we're going to do it, who's going to do it, how much is it going to cost. Because there's a unique opportunity here to really build bring together a global movement, but we have to be careful to remember that if we're going to do that successfully, there's going to be all sorts of participants. And the second point I wanted to make, I'm on the board of the Global Impact Investment Network, and I had, at the most recent board meeting, this subject came up, these principles, and my contribution was to say, well, this is fantastic. The IFC have stepped forward here. They are trying to bring together a clear, verifiable set of principles. I was frankly surprised by the reaction of some of my other board members. Their reaction was, IFC, big, government-owned, bureaucratic organization, what do they really know about investment? And so I think it is really important just to remember that it is not necessarily the case that everybody who's part of this industry today necessarily buys into the fact that the IFC should own these principles. And so the key is going to be, how do you bring in this mainstream, very fragmented industry to accept that the IFC is the appropriate organization to lead that. And I think the team's been very collaborative so far, but as we go forward in the consultative phase, it's important to try to reach out even more broadly, to be even more collaborative.
Thank you. I wondered if any of the panel had a response to that. Axel, potentially. Is it as easy as all that for UBS?
No, so I think what you need to avoid is a bifurcation, trifurcation, multi-standards that all coexist. And we just recently in our Investor Watch asked about sustainable investment, and 72% of our investors say they're completely confused around the language around that. So there's a huge demand for clarity here. And I think it's not necessary you just have one standard, but there are so many standards that could potentially evolve, that ownership is key. I talked about the principles for sovereign debt restructuring, which are located at the IIF. And those were very important principles when we came out of the sovereign debt crisis. You might remember, those of you who've been around these meetings for some time, there was the Asian financial crisis, there was the South American crisis. I see some in the room who probably only know that from history books, but there were so many sovereign crises that it was important to have principles around how to restructure sovereign debt, and those principles were very useful. They were very useful for bringing Argentina back into the financial market. And ownership of the IIF was created, and Charles knew that because he was the CEO then, it was created because the whole financial industry and an industry organization should sit at the helm of owning these principles. So I do accept that there are questions why the IFC or the World Bank Group should be the owners of such principles, but my view is you have to start somewhere. And since you have to start somewhere, it is very important that you get a key global institution with a huge credibility to define those standards. And then, of course, you can have, mutations of those standards, potentially with the standards that are better than these standards, or at least equally important that you apply to. But there should be one underlying principle. The United Nations has already developed a very similar set of standards, and the risk I see is simply that too many standards just add to the confusion rather than really sort of define the bar that is needed here. So I'm pretty pragmatic on ownership. I think somebody has to own it, and I always looked at the IFC as a good starting point.
If I may just briefly add a point there, one of the fascinating things about the principles for sovereign debt that Axel mentioned is that it is guided today by a group of trustees who are both public officials and private sector leaders. Axel is one of the chairmen, the co-chairman of the group of trustees. So is the governor of the People's Bank of China. And so it is that mixture, that integration, informal as it may be, of public and private, that's important. The IFC, in drafting these principles, reached out to private sector firms, represented here today, and others. And an advisory council could easily be established around the process by the IFC, but still with the IFC holding the reins, that can give a broader framework of credibility to this outside the bureaucracy of Washington. And I'm sure that's what the IFC has already been thinking about. But those things are important. I think in the end of the day, though, I completely agree with Axel and Philippe and others that it has to start at one place. The IFC is very well positioned. It is, after all, the arm of the World Bank Group that is most connected with the private financial markets. In organizations like mine, look up to the IFC. We respect the IFC platform. We respect the credibility. And we're delighted to be working under IFC leadership.
I know that Valdis wanted to come in, and then Andy, and then I will return to the floor. So, Valdis.
Well, yes, I wanted to come back to this point on standardization, which was raised, and proliferation of different standards. I think this is indeed one of the issues we need to deal with, and that's why we're now trying to come with an EU-wide standards. And what is probably a novelty here is that we are going in a sense step further and putting certain requirements in a hard law. Of course, while doing so, we also need to be careful. If we discuss, for example, environmental taxonomies or climate change taxonomies, it must be clear that they will adjust over time. Our thinking of what is sustainable will evolve, and our taxonomies, our classification systems will need to evolve. And that's how we are setting forward our legislative proposal. And also, I was concentrating in my introductory remarks on environmental, on climate change aspects, but it's true that we eventually intend to expand our taxonomies also further in social, in governance, so covering different ESG aspects here. And on this work, not that when we do something in the EU, of course, we need to follow the international developments. And to give an example, we are now, for example, looking how we can make our disclosure requirements closer to the work of financial stability boards, climate-related financial disclosures, so that what we are doing in EU is consistent with the global trends. But in a number of things, we want to be in a forefront, and probably will be the first putting certain requirements in a hard law.
3 days ago, I was in Delhi, and I come from a meeting with the CEOs of the Global Impact Investing Network and the Global Steering Group for Impact Investing. And Nick raised a great point. How do those organizations come along with the IFC and World Bank on this journey? And I will say that I asked them very directly, do we need these principles? And is it helpful to have these minimum standards? Because they do many valuable things and include many pioneers of the space that have been working on this for a long time. And Amit Buri and Amit Bhatia, who are the two CEOs of that, stated emphatically to me, and that I could bring it here, that they were supportive of these principles. Now, what that means and how we involve them is a deep question, but I think there is the will in this community to come together to really behind a number of systems and standards that really grow it to be a much, much bigger community. It sounds glorious to be pioneers, but actually it's hard work. It's much better if you're well understood by the financial markets and others. And I also just wanted to say that Nick and CDC have been very important figures in this space for a long time, being very rigorous in it. And 10 years ago, when the first bank, JP Morgan, invested in Leapfrog, it was not because there were systems, it was not because we ticked any box, but it was because an executive committee member, Nick O'Donoghue, decided that this was something that JP Morgan should do and get into. So as we look back on a decade of work in this, the danger now is going towards the narcissism of small differences and petty status anxieties and notions about who should own what. The reality is we have some very clear organizations, the World Bank and IFC's convening power, the Global Impact Investing Network, and the Global Steering Group on Impact Investing that command universal acclaim and understanding and have unique forms of credibility. We need to bring them together. We need to bring them behind these principles. And then whoever ends up owning it, being the sounding board, the advisory committee, we'll make sure it's broad-based. But let's all come together in this next 6 months, let's consult widely, and let's have a final set that allows us collectively to move to the trillions.
Thank you. Questions from the floor? Yes. Over this way.
Actually,
thank you.
There we go. It wasn't really a question, but it was a couple observations. One, we at Credit Suisse have been also part of the group to help draft the principles, and since we haven't been described what they actually are today on the panel, I thought it was helpful for the audience to understand that these aren't prescriptive. It is a way of thinking, a process to go through, and a rigor for those who are involved in impact investing and deeming anything that we call impact investing to be aligned with those principles. Because when we're talking about traditional finance, and it's a simple risk versus return lens, it's very easy to be standardized. When we're trying to compare an education impact investment with a climate change impact investment, they're apples and oranges and you can't. So I think the prescriptiveness of this is a bit of a misnomer, and I don't think we should leave people with that impression that the standardization means that you can compare across these different types of investments. Another observation I would make is that when we have this question, should it be the IFC who owns this, or is the overarching body to lead with this? If you think about the UN, someone could have questioned why the UN for the sustainability goals, but look how quickly and effectively that has proliferated and become the lexicon and the language for everybody to frame their thinking about the world challenges. And the reason I think that they've been so effective at that is the broad outreach. And that's where I want to commend the IFC, because they've reached out to asset owners, big and small, private equity, banks, insurance companies, all to come together to help write these principles. And then if it wasn't clear to the group, this is now going out for public consultation until December. So anyone in this room should be invited to participate, so then we can all own this as a collective. So that's all I want to say.
Thank you. I earlier received questions from online as this is being live streamed, and perhaps Charles, I mean it's a theme we've touched on, but the question was, what can be done to get mainstream investors like pension funds in the US and Europe to really get into impact investing?
You know, I think pension funds are coming around to the idea of impact investing. I mean, I think one of the myths that we need to explode with pension funds is that there is no trade-off between impact investing and solid returns on their assets. And I think many pension funds are still a little skeptical about that. Not all of them. Certainly there are leaders in the industry. But I think it is crucial to reach out to the pension funds, to reach out to the sovereign wealth funds as well. There are many different attitudes in these sovereign wealth funds today, and we work with a lot of them. The other firms up here do as well. And you'll find some that are already becoming quite attuned to the benefits and the importance globally of impact investing, and others kind of wave their hands and dismiss it and say, that's not my cup of tea. I think we really do have to collectively here, and many of you are representative of governments that have sovereign wealth funds. I think we have to collectively stimulate the dialogue with the pension community. We need to bring them into this dialogue. My firm is part of an organization called the Pacific Pension Institute. And just this morning, meeting with IFC staff, we discussed the idea of bringing the IFC in there to present these principles. This does need to be, I think it's wonderful that there's a 6-month period for discussion here, but the dialogue will take longer than 6 months here to spread the benefits of these principles and to explode some of the myths around impact investing.
Marianne.
I would make a comment about that point and the last one from Credit Suisse, which is go together in many ways. I was with the institutional investor group from the RISE Fund and the experience there in September, and they strongly pushed us in a wonderful way towards independent and third-party neutral understanding of what was going on, and actually to help contribute to not simply principles, to use this as a starting point, but actually to move towards the kind of metric that they could use to compare, that would allow, and this is, UBS was a part of that conversation, that would allow the generation of things down the road like index funds, that would allow for us to wake up 10, 20, 50 years from now and talk about the impact return on capital in the same way that we talk about IRR and other types of return. So this is a starting point, and we will not get to that in 6 months. So we need to follow this process quite critically. But it is a challenge to all of us to say, what will it take for us to get to that next level that will allow us to unlock the kind of certainty and comparability that will allow the institutional investors to assess across their opportunities and allow for the development of further types of products and markets the way that Axel was describing. And we can do this, but it is a challenge.
At this point, I'm afraid to say we are starting to run out of time, and so what I would like to draw to everyone's attention is the website displayed, because the principles can be found there, and as mentioned, there is a comment period for the next few months. Hans-Peter is going to explain a little bit more about this in a moment, but that is where you can read them and also comment on them. As we draw to a close, I'd like to invite each panelist to give their I don't like this phrase very much, but their key takeaway, their food for thought at the end of this panel. And then perhaps, Hans-Peter, you could finish things for us by just explaining the next few steps. But we'll start with you, Andy.
Thank you. I think there is a risk of being at 50,000 feet and not grounding all of this in the reality of investing of companies and of those companies serving people. So I would encourage people to think about how these principles, which are tremendously important draft principles, will apply for investors and ultimately what it will mean for companies on the ground and the emerging consumers they serve. At Leapfrog, and we try to put texture around each company, what social and environmental goals they have, and we try and be very explicit about that, what the metrics are that we'll measure them by. Our website, leapfroginvest.com, has a set of, every company has a description, has a careful analysis of each of these different dimensions and the risk piece. And if you look at that and you immerse in that, you start to realize that these principles have profound implications for millions and millions of people. Are they receiving quality, affordable, and relevant services? These are people living on often under $5 or under $10 a day per person. We have a responsibility not to let these principles become so separated out that they become pure abstractions in the financial market. We have an obligation to design them, as the IFC has done under Hans-Peter and Neil's leadership, to make sure that they reflect the reality of companies and investors working on the ground. And if we can do that properly at this point, we then will, when the trillions come in, know that they're headed towards the right place, not just celebrate trillions in their own right. And I think for profit and for purpose, for profit with purpose, that's the crucial thing here.
Thank you. Charles.
You know, when I was a young civil servant at the Treasury Department back in the 1970s, I was motivated, like many of you here today, to make some contribution in some way to the global economy. And yet, at the same time, friends of mine who went into the private sector couldn't quite conceive of making a broader contribution to the public good. Today it's different. We have an opportunity today, not just through these principles, but in many different ways. We have an opportunity, if we really put our minds to it and if we really follow through, to unify aspirations of the public and the private sector, not only to generate profits for our pensioners and other asset owners, but to contribute substantially to making a difference in the world economy. And I think that's a tremendous motivation that all of us should share, the public and the private sector coming together here. I think President Kim set a tone on that this morning. It will take some adaptation of all of us. Private sector firms, private investors, private equity firms like ours will have to think a bit differently. Public institutions like the World Bank will have to think a bit differently. And we will have to make it work on individual projects day after day, month after month, but we can do that, I think, working together.
Running a large global wealth management company, it's all about one thing. Filter out the noise and look at the long run. Our investors are not interested in quarterly or short-term returns. They're interested in solving generational problems. Financial markets are 90% noise, 10% fundamentals. What you need to do is listen to the fundamentals, forget the noise. These principles help to focus on projects that have longevity. Long-run success is the key thing. Don't measure it in quarters, measure it in years, measure it in decades. And focusing on sustainability. Companies with a sustainability focus are successful in the long run. And that's what you should be worried about as an investor. These principles help you focus your mind.
Well, what I would say as one of the key takeaways here is, first, as we discussed, there is a demand for investors, for impact investment, for sustainable investment. So what we need to provide, clarity. That's why the principles are important. That's why the classification system is important. Disclosures, investors or fiduciary duty, labels potentially, and then we will see that this impact investment, sustainable investment will quite quickly move from a niche, from some, as we were saying, maybe even theoretical discussions. It very quickly will be moving into mainstream, and that's what we should be facilitating, both by the means of public governance and by initiatives of financial market participants. Thank you.
These principles call us to be more rigorous. They call us to ensure that what we do is driving impact. We up here are proof positive, as are others, that these can be operationalized, these can be made real, these are not simply good ideas. And I would encourage us all as we progress in that to continue to think about the fact that impact is not binary. It's not simply, we have to move at this point. The sums of money being invested are so consequential, and the hope is that they will become more consequential, that we have to move beyond the intent to have impact. We have to look at the effectiveness of that. We can turn with rigor and good practice to research to underpin that. And in that way, we can move to a point where we unlock effective capital for the future and for these incredibly important challenges that our planet and its people need us to engage in.
Right. One thing I take from today, and that I take from the past year or so that we have been engaged in discussions with the partners here, with the broad range across the industry, is that there's a lot of sincerity behind these words, behind these desires to achieve impact and returns. This is not a fluke. This is happening. And I think what we've heard today is that it can become a major part of the development landscape, a major part of the development solution. So one thing I feel is we're broadening the scope of the development community from the DFIs to incorporate the impact community, and that should give us a lot of hope that we can achieve progress on the SDGs. There's also clearly a desire or a need for standards. There's a need for a discipline around this, and we've heard this today, and that was the motivation of this whole exercise. And that is what we will now continue to work on. We have today launched a consultation draft of these principles. This is now on the web. We will actively, together with our partners here, try to bring in as many as possible into this discussion over the next few months. Anyone can approach us, but we will also proactively try to seek these views. We want to broaden this beyond the impact and DFI community, get civil society to become part of this discussion, and anyone who feels a strong desire to contribute. So that is the purpose of this, the next few months, to broaden the ownership. This has come up before, so that by the time of the spring meetings, we have a good draft that where a very broad community of players can feel they stand behind that. This is the discipline that we're looking for. That is the objective that we have. And just to note, and I think Charles said that, or Axel, this is going to go on. If you look at the Equator Principles, those were established at one point, and then they continue to evolve over the years. And I'm pretty sure that will be the case here as well. This is a humble beginning, disciplines around the management for impact. We will see how far we can take it over the years in a very broadly managed process. So just to mention, one thing is, in addition to the names that you see on the brochure, we have had Barclays, Bank of America, and FMO join us just these last few days in support of these principles, and I'm sure this is now going to go on and become a larger and larger group. We all have still certain challenges in meeting these principles ourselves. We're going to work on ensuring that we're able to fully stand behind them as institutions, and that includes the IFC. So we really very much look forward to reconvening on this topic at the time of the spring meetings, and then be able to launch with our signatures this set of principles for impact investing.
Thank you, Hans-Peter. And it's not often that I get to finish or close a panel that is actually the beginning of an exciting process, but that's clearly the case here. I'm very grateful to you all for your insights and for being here, and please join me in thanking the panel.